There's an absolutely staggering amount of money in leveraged funds right now, betting that the market will continue to rise. If you take a look at this chart, the first thing that you'll notice is that it's at an all-time high. This chart is the total leveraged bull-bear ratio. In other words, it measures the difference in how much money is in the leveraged bullish funds versus the leveraged bearish funds. And it has never been this high before. Specifically, it is at a ratio of 100 to 1. That means for every dollar that is in a bearish leveraged fund, there's about $100 in a bullish leveraged fund. An example of a bullish leveraged fund would be something like SPXL, which is designed to move 3 times whatever the S&P 500 does per day. And yes, this leverage works both ways. So if the stock market rises 1%, then that fund should move up 3%. If the stock market falls 1%, that fund should fall 3%. Now I'm going to show you why these funds are so dangerous, whether you're on the long side or the short side. But first we need to take a look at what happened last time this bull to bear ratio was so out of whack. Take a look back at this chart and you can see the last time it peaked was right at the end of 2021. Now, if you pay attention to markets, that should ring a bell for you because late 2021 was when the stock market peaked. The bear market that started after saw a drawdown in the S&P 500 of 27% from top to bottom. Keep in mind, this bull to bear ratio only reached about 80, and we have blown way past that. The one main thing that this ratio communicates is how over-positioned the market is on one side versus the other. Tops form in markets when all of the actual and potential buyers have already bought. That means there's no money left to buy. That means the only potential actors left in the market are sellers. And when those sellers then overwhelm the buyers and the market starts to move down, the people who are buying only because that was still going up are going to turn into sellers themselves. Similarly, markets don't bottom until all actual and potential sellers have sold and the only people left acting in the market are new buyers. Now I'm going to show you why these leveraged funds are so dangerous and you shouldn't touch them with a 10-foot pole, whether you are buying or shorting them and whether they are long or short funds themselves. The first and most obvious reason is that leverage works both ways, which means if you're invested in one of these leveraged funds and the underlying begins to sell off, you are not losing the same amount as you would in the underlying, you are losing triple that amount. In the case of SPXL, it went down about 66% from peak to trough in 2021 and 2022. Now, I don't know about you, but a 66% loss does not sound that fun to me. But for these leveraged funds, that's actually pretty normal, especially when you get into leveraged funds that invest in things other than just the stock market, like volatility funds like SVXY. You can see within the course of basically days, this fund experienced a 92% drawdown and has never and will never get back up anywhere near where it was at its peak. Leveraged funds can experience blow up themselves from the leverage that takes place inside the fund. And even if the underlying someday recovers to where it was before, if you're in the wrong leveraged fund, your fund may actually blow up, leaving you with way more losses than you would have ever had if you had just been doing the leverage yourself on the underlying. Now, the crazy part is that even if you take the opposite approach and you say, okay, well, I'm going to buy the opposite funds that when something blows up, these things will do great. In other words, short leveraged funds. You're more likely to lose just as much money. It'll probably just take a little bit longer. For instance, take a look at this fund called SPXS. This is the inverse of SPXL. In other words, it is a 3x leveraged fund that does the opposite of the S&P 500. So when the S&P 500 goes up 1%, this thing will go down 3%. If the S&P 500 goes down 1%, this thing will go up 3%. So a lot of people are thinking probably right now at this point in the video, given the fact that there's so much money invested in leveraged long funds, it would pay to be a contrarian right now, dump a bunch of money into leveraged short funds. It's a guaranteed win. And please do not. Here's why. While this short leverage fund has been pretty flat over the last month or so, all we have to do is zoom out a tad bit for you to see this is a very, very, very bad idea. Even just since October of 2022, this fund has lost about 80% of its value. And if we zoom out a little bit farther, you can see that it just doesn't stop. On a split adjusted basis going back to 2009, the high for these shares was $162,649. That's compared to today's price of just around $6 per share. This answers the question that a lot of people ask when they say it's already down 90%, how much more could it go down? The answer is another 90%. And from there, it could go down another 90%. And from there, it could go down another 90%. And that's exactly what funds like this do. They drop 90% and then another 90 and then another 90 and then another 90 in perpetuity forever, losing people's money forever. And you can see as we zoom in, even when there are giant crashes in the stock market like we had in February and March of 2020, this fund, while it did increase by 149% over that time period, zooming back out, we can see did absolutely nothing to get anywhere near what this fund was worth just a few years prior. By the way, guys, if you're looking for a way to profit from this situation, I have a bit of an urgent plug for you here, because this Thursday, that's the 23rd at 7 p.m. Eastern time, I'm hosting a completely free asymmetric trading masterclass. And this is your last chance to register for the event. The last time I hosted one of these masterclasses, we had more people sign up for the event that could actually fit on the Zoom call. And this time we may end up with many more, which means you don't have long to secure a spot for yourself. With a new president about to take office, volatility building pressure all around different areas of the market, financial regulations and money flows changing, I don't have to tell you that 2025 could get wild. And you'll want to know how to profit from the coming sea change. That's why I'm going to show you the best way I know to profit from the market chaos, both to the upside and to the downside. I'm even going to do a live Q&A at the end of the call to discuss any questions. Remember, this masterclass is completely free. All you have to do is sign up with the link in the description below to attend, but only a few days are left and spots are filling up fast. So click the link, put in your email, save it on your calendar, make sure you show up a few minutes early, and I'll see you there. This happens as a result of something called beta slippage. In other words, these funds have the leverage performance of the daily price action of the underlying. So whenever there is any volatility over time, that intrinsic value will bleed out of the fund. Let me give you an example. Let's say the S&P 500 goes down 10% and then goes up 10%. If you had invested $100 on that first day, where do you think you would be after those 2 subsequent days of performance? After day 1, you've dropped 10%, so you're at 90. When you go up 10% the next day, where are you? You're not back up to 100, you're at 99. And it doesn't matter the order that you do this in. If you go up 10% from 100, you're at $110. And then if you go down 10% from there, you're subtracting 11, not 10. So you're down at 99. Either way, you're worse off than you were before. Now, you're only $1 worse off, in other words, 1%. But this gets exponentially worse the larger your numbers get. For instance, if you start off at 100 and you drop by 50%, you go down to 50. Now, if you go up 50% from there, you're only back up to 75, because 50% of 50 is 25. Add that to 50, you're at 75. And so if there's ever any volatility in the underlying, which obviously for something like the stock market, you're going to sometimes have some volatility. That means that beta slippage is amplified in the leveraged fund. And this happens on the long side too. You can see that the S&P 500 had a short-term top on October 17th of 2024. As of the date of this recording, the S&P 500 is up 0.7% from that point. You would then incorrectly assume that the leveraged long fund should be up about 3 times more than that. But in fact, the leveraged long fund is down about 1.3%. Again, this is because the leveraged long fund does the 3x or the 2x, whatever your fund is, of the underlying for that day. So if your underlying instrument is just chopping sideways, moving up and down and volatile, your leveraged long funds and your leveraged short funds will both just move lower. And to put the final nail in the coffin for everybody sitting here thinking that they've finally figured out a hack and a way to make guaranteed money on these things, no, you can't just short these shares because they are designed to bleed out, which means everybody who has any common sense knows that these things are destined to go down over time. which means that it's probably going to be pretty hard to borrow the shares in order to short them. Anybody who is dumb enough to own these shares and lend them out for somebody else to sell and short will be demanding a pretty high interest rate in order for you to borrow those shares from them. And 99 times out of 100, that interest rate you're going to be paying to borrow those shares is going to cost you more than you will profit on the shares decline. Now, the final thing to note here, and this is kind of where the action plan comes in for you, is that there's nothing inherently wrong with the strategy that these leveraged funds are using. The problem is that they have to use it constantly regardless of market conditions. In other words, let's take a look at the stock market during mid-2022. You'd already experienced a large sell-off, and by the time you hit the bottom, the stock market had dropped over 25%. Most semi-active investors would be taking a look at the stock market at that time and thinking, hey, if I were a betting man, would I be wanting to place a bet that the stock market has finished its correction and will probably move higher from here? Or would I want to bet on even more downside, even after all the selling? Anyone with an ounce of contrarian blood would be taking a look at the decline in the stock market and thinking, it might be a safer bet to go long at this point. That means you can dynamically adjust your strategy and your positions based on what the market is showing you and what the market is doing. Similarly, let's say the VIX has recently just spiked up above 60. Would you be sitting there looking at that and thinking, oh, I think it's going to go to 120? Or do I think that there's a higher chance it'll go down? Or when the VIX was sitting and chilling around the 12 to 13 level for so long, would you be thinking, oh, it's got a higher chance of going down to 5? Or maybe I put a little money on a spike in volatility. In other words, it is smart to be dynamically adjusting your strategy based on what the market is telling you and not just stick to a strategy because that's what's been decided for you by the prospectus of the fund. All of these leveraged funds, every fund that trades derivatives and uses futures and uses options and uses a ton of debt in order to just participate in one single strategy, regardless of what the market is doing at the time, is destined for either blow up or failure over time. There's nothing wrong with buying calls or puts on the VIX. You just don't want to be constantly buying calls on the VIX or constantly buying puts on the VIX. There's nothing wrong with using some leverage from time to time to buy some stocks. You just don't want to be doing that constantly when margin rates are 12%. If you're sitting there thinking that it's dangerous to even try to time the market because usually you're buying things at tops and selling things at bottoms, don't go all in with your portfolio. There is a strategy called Core and Explore, which means you have about 80% of your portfolio in a never touch it, dollar cost average. You're just buying more shares and accumulating over time. But with about 20% of your positions, you allow yourself the freedom in order to dynamically adjust given the market. When stocks rise and look really frothy and we have a bear to bull ratio of 100 to 1 in leveraged funds, you can take a little profit off the top. You can explore with a portion of your portfolio, maybe get a little dry powder on the side. And during times when that corrects and asset prices seem to be on sale, you can explore a little bit more, add to those positions again, and you can trade around your core position. That way you're never completely out of the market, you're never completely in, you're dynamically adjusting, and if you're wrong, it's not going to make that much of an impact on your portfolio because you still have the core that's always going to be invested. You can dynamically watch the VIX and see the rise in volatility. When puts are cheap on the stock market, buy some puts to hedge. Do these things dynamically as you need to based on what the market is doing, not what you think it should be doing, not what you want it to do, but what's actually happening. And again, if you'd like help with all of this, attend my free asymmetric trading masterclass coming up soon. Click on the link in the description below. As always, thank you so much for watching. Have a great day.